Welcome to Meow Money, where we turn tricky finance into fun, bite-sized tips. Let's dive in.
Ever notice how cats always land on their feet? That's kind of what bonds do for your money. When the stock market jumps off the couch, bonds help you land softly. So what is a bond? Think of it like this. You're lending money to a government or company, and they promise to pay you back with interest. You're basically the calm, responsible friend who says, "Sure, I'll lend you $1,000, but I want snacks in return." Stocks equals ownership roller coaster, bonds IOU with a steady paycheck. Why do bonds exist? Because companies and governments need cash. Instead of borrowing from a bank, they borrow from you. And you get predictable income in return. Now here's the fun part. Bonds are your portfolio's shock absorber. When stocks fall 20%, good quality bonds often don't fall as much. Sometimes they even go up. That helps you stay calm and not panic sell your future. But bonds aren't risk-free kittens. There's something called duration risk. Duration is basically, how sensitive is this bond to interest rate changes? Longer duration equals more dramatic reaction. If interest rates rise, long-term bonds can drop more. Short-term bonds? They're like chill indoor cats. Less dramatic. Practical everyday example. Saving for a house in 2 to 3 years? Short-term bonds or bond funds. Retirement 20+ years away? Some longer duration bonds can make sense. Simple beginner bond picks many people use. Total bond market index fund, broad, diversified. Short-term treasury fund, very stable. I bonds for inflation protection. You don't need 17 fancy bond products. 1 or 2 simple, low-cost funds can do the job. Bonds won't make you rich overnight, but they help you stay rich when markets get spicy. And that's how bonds keep your portfolio landing on its paws. Soft, steady, and still purring.
Thanks for watching Meow Money. Like and subscribe to keep your savings purring. See you next time.